Welcome to the Times of Industry show. I have Alasdair Macleod with us, Gold.com, a recurring guest, a returning guest, one of the most, one of the best writers in the field of precious metals. His stories and articles often get shared on ZeroHedge.com and many other publications. Very popular guest on shows because his research goes in depth. And I almost want to call you a financial historian of the gold sector. You know so much about the last few hundred years. It's just amazing. And I was just to share with the audience, literally, we're doing this call here in Tel Aviv. It's 7 p.m. right now. So we're doing this call on a Tuesday, 7 p.m. Israel time. I'm looking at gold at getting smacked for like a few days. And I just bought Fizz myself. So Fizz being the physical trust for Sprott. And I know you want to share with us a little bit later more about goldmoney.com, which is a great product as well. So let's get right into it. Why is gold tanking so fast and so badly?
Well, it often happens like this at this time of the year. And the reason is very, very simple. And that is the expiring December calls. I mean, as you may imagine, a lot of bulls will have bought out of the money calls over the last 6 months or so, having seen the price of gold rise. And there are lots of calls outstanding. And by knocking the price back to $1,800, basically they make approximately 150,000 call options completely worthless. That's all you need to know. That's why so often what happens is that the market gets knocked ahead of the December expiry, and then guess what? It turns in December and suddenly you've got a bull market again. Now, the conditions are there for a repeat of that. So far, what we have seen is the knockdown to remove, if you like, all those very, very expensive call options, which the bullion banks would rather not see expire with any value.
Just so people understand this, what is the incentive of the banks to, or the bullion banks, et cetera, to drive the price down to make those options expire? That's first question, so people can understand the incentive behind this. And secondly, is there a legality in terms of regulations? Is this perfectly fine what they're doing in terms of the way that they operate? And third, how much is 150,000 options? In other words, is it a big part of the options market for gold?
Yeah, okay.
Unpack that.
Right, the first question. I'm trying to remember what the first question was now. The first question was...
the first question was...
Yeah, okay, no, I've got it. Basically, when you go into the market and you buy a call option, you are sold the call option by a bullion bank. Equally, if you go and you buy a put option, you're going to be sold the put option by a bullion bank, and the bullion bank will run a book on, puts and calls and all the rest of it, as well as a book on the underlying futures. So it's a reasonable bet that the vast majority of those 150,000 call options expiring worthless were on the books of the bullion banks. So instead of them costing the bullion banks money as they expire, then basically they just say, that's it. It's, what we took as money is pure profit. So that's the first thing. Your second question, I don't know whether it was the second or third, was about the legality of it. Now that is an extremely good question. And I mean, all I can say is that markets are tough and...
Yeah, because basically they're using the customer's database. They know where all of the, where the majority of these options trade, and they just flush them because they can use leverage.
Absolutely. And I mean, the thing that is really questionable is the degree of compliance, if you like, between various bullion houses to rig the market, which is actually basically what happens. And I think there's sort of two answers to that. One must admit that dealers get together and have a drink in the bar after work and and they talk about this, that, and the other thing. And it's very easy to go from that sort of banter to, if you like, sort of unofficial or unrecorded agreements that, look, I'll bang the price tomorrow and then you can come in on top of it, but I'll give you the tip when I'm going to do it.
Okay.
Yeah.
And
This is the
why
sort of-
doesn't anyone on the other side see this and um, and play the other
Yeah.
side of this? Why isn't there
Well,
a body strong enough to do that?
well, part of the answer is that the people who buy calls are eternal optimists. And of course, if you're an eternal optimist, it means that you're probably not a very good trader.
Mm.
And of course, that is what they capitalize on. The other thing they capitalize on is in the underlying market is hedge funds. A hedge fund trade, they're not interested in taking delivery. The way they look at it is sell dollar, buy gold, or sell gold, buy dollar. That's all they do. So they look at things in pairs, as it were. And that does mean that if a bullion bank manages to push the market lower, and the other way they do this is spoofing, which is placing an order just outside the price, so that people in the market can see, oh my God, there's a huge, great seller. Quick, we better dump our stock.
Mm-hmm.
And then the spoofer doesn't actually have to do anything, but he will see his short position
just a threat
get less and less expensive. And, basically it then starts triggering out the stops, because this is the other thing. I mean, I'm an old-fashioned stockbroker. I would never tell anyone what my position was. But the moment you go into the market and you put a stop in, you're telling the market what your position is.
Sure.
And of course, they all know where the stops are. So they all know how much they've got to bash the market to take them out. And by taking out the stops, you create an avalanche of selling, which does the work for you. So It's all these techniques. And this is why I always say to people, look, if you want to punt in gold, then your life is in your own hands. Just bear in mind that punters usually lose money. Yeah. I mean, the statistics say that something like 70 to 80% of punters lose money.
What do you mean by punters?
Well, punters, I mean people who go into the market and take short-term speculative positions. You sort of, you see the chart's rising, so you think, okay, I'll buy some, and then you see it falling, oh, I better sell them. That sort of nervous day trading. I mean, 80% of them lose money. So, are you really going to be so clever that you're in the 20%? If you've got an opinion on anything, the answer probably is you're not going to be clever enough to beat those odds. Yeah. So what I say to people is, look, the whole purpose of gold, as far as we are concerned, is an insurance, if you like, against the day when paper money loses its purchasing power. Now, it's been doing this, it's been doing this for a very, very long time.
Exactly.
I mean, ever since Nixon suspended the Bretton Woods Agreement in August 1971, gold moved from the then price where you couldn't deal with the Americans at $44. It had previously been 35. Up to where are we now? We're up at around about 1800. So you can see how the purchasing power of the dollar has collapsed measured in gold. It's something like it's lost 92%. Yeah. So this is that, really what you want to do is not to get, lose money day trading or short-term trading. But what you need to do is to just think, what is gold? Gold is money, and it's sound money. It is not an investment. An investment is something that you put into a portfolio with a number of other things, and you look at the risks and all the rest of it, and that decides your allocation. And you buy an investment with an intention to sell it at a profit. If you do that to gold, you are misunderstanding really what it's about. It's about protecting yourself against a fall in the purchasing power of your currency. Now, I know that Israel has had, I mean, I don't follow your currency at all, but I know in the past it has been a very weak currency. Anyone in Tel Aviv who sort of owns gold will have rejoiced in the fact that they've got some protection against it.
You're referring to something that happened before I was born. In 1982, there was a hyperinflation of the Israeli lira, and then it changed to the new Israeli shekel. There was a period of hyperinflation, but the currency is very stable in the last 34 years. I don't want to say it's correlated to my birth.
But hold on, is it stable against the dollar, or is it stable against
it's right now at a 12-year high against the dollar, literally as we speak.
Very good.
So that's pretty cool. and obviously that would mean that it's doing better than other currencies against gold. But like you said, short-term speculation in gold is so it just defeats the purpose, because if you just held on to it, I mean, you made money no matter almost no matter when you bought it.
Yeah.
Unless you bought it in the last 2 months. So that's interesting. Okay, so let's ask you about the future. We talked about the past. You have Bank of America Gold 3000, Wells Fargo, and Goldman Sachs Gold 2300. You have Paul Singer saying it's the last undervalued asset in the world. I can go on and on. The Ohio Pension Fund and firefighters put 5%. So from 1,800 to 3,000, that's a pretty big move.
Well, it is if you look at it as an investment. But if, on the other hand, you're looking at the dollar and you're thinking the dollar is going to lose purchasing power, then if, let us say, the dollar falls against a basket of commodities by 50%, then you can see that the purchasing power of gold should be somewhere, like the 3,000 level. It really doesn't. It really, the way to look at it is the other way up, if you like, from, gold is going to 3,000. I mean, that's a completely meaningless statement. What really means something is the dollar is going to halve.
Gotcha.
Or in this case, we're talking about roughly halving, aren't we? So is that possible? Well, we need to look at the economics of the situation. Before this COVID thing started, the global economy was beginning to slow. And there were two reasons for this. Firstly, we had a long period of bank credit expansion, which meant that the bank balance sheets got too expanded and they couldn't expand anymore. And of course, when you stop blowing up a balloon, it tends to come back down again until you get to a point where the contraction in bank credit starts undermining if you like, the debt structure in the markets. So that's the first thing. The second thing is that America and China got into this trade war with pushing up tariffs and all the rest of it. Now, the reason this matters is that if you go back to 1929, you had a combination of, guess what, end of the period of expansion of bank credit, and you had the introduction of the Smoot-Hawley Tariff Act, which basically pushed up tariffs by roughly 20% against all imports in America.
Interesting. So we're making that comparison.
Yeah, so we've got something very, very similar. Now, that on its own would suggest that the American economy, and therefore its currency, is in mortal danger. We then have the first wave of COVID. And the thing that is amazing is the amount of money printing that was done by the Fed.
That is amazing.
To finance the rocketing budget deficit of the US government. So much so that if you look at the second half of the last fiscal year, in terms of government finances, roughly 2 parts of their finance came from inflation and 1 part came from taxes. So already the US government is highly dependent, in fact, totally dependent on increasing inflation and, if you like, keeping monetary inflation going.
What do you mean by that?
Well, basically, in order to finance the budget deficit, the Fed had to put cash into the economy.
So monetary intervention by the Fed is your...
Exactly.
So you call it inflation.
Of course, that is inflation. The original definition of inflation is an increase in the quantity of money.
Understood.
Price inflation is just the effect. So what you've got to look at is the money side. Okay.
Yeah.
Right.
So when you say, just so our listeners can understand, when you say, hey, 2020, we saw a lot of inflation, you mean that we saw an expansion of the currency supply by the Federal Reserve, which helped to pay for all the expenditures and not the tax receipts from IRS and otherwise.
Yeah.
Okay.
You've got it. That is precisely it. Now, so that was the situation in the second half of the last fiscal year, which ran from March to September. And that's actually quite convenient because on March the 23rd, the FOMC turned around and said, we will print as much money as is required.
Sure.
Or actually, what they said is, we will do as much QE as is required.
I remember
and we will
that.
go and buy corporate bonds, and we will do agency debt, and da-da-da-da-da.
Yeah.
So, you know, in other words, they were going to issue as much currency as the market demanded.
Okay.
And the objective of that was to finance the government deficit, which, as I just said, in that half year, it turned out that roughly 2 units, if you like, or 2/3 of it was done by inflation, and 1/3 of it was through taxes, because obviously taxing, you know, income fell,
Yes.
expenditure rose, and all the rest of it. Now we have the second wave. And okay, the whole thing's been interrupted by the presidential election, and that has not been resolved yet. So that, if you like, has delayed the package, which undoubtedly both parties, Democrats and Republicans, reckon there's got to be another package, a helicopter drop onto onto everybody's bank accounts, and so on and so forth.
Yeah.
So we're going to get another one.
Yeah, we will, for sure.
Yeah. So, but already 2/3 of government financing is done by inflation. Right. We're now in the situation where businesses have now really gone bust, bankrupt. The Fed is effectively underwriting the bad debts in the banking system. And so what's going to be the size of this package? And the other thing, of course, is that they've already diluted the amount of the purchasing power of money. In theory, it hasn't reflected in prices yet. Prices are, if you like, the price indexes are managed quantities, so don't look at that at all. But you know, you just know that with the injection of an extra 30% of M1 money, which is what we have seen, that has decreased, if you like, the eventual purchasing power of every existing unit of money in circulation. So now we've got to have the same monetary effect the same real effect at least by the next tranche of money printing. And so that means that this time it's going to have to be 40%, because you're dealing with a diluted dollar. So you can see that this is something which, once you get to a certain point, begins to get exponential. And that is really what we're seeing. And don't forget that if we are lucky enough only to have 2 waves of the COVID virus in America, then you've still got this background, which I referred to earlier, of bank credit expansion having come to an end, the tariff war with China, and so on and so forth. I mean, it's not as if everybody's going to go back and say, look, forget everything, it's all right. We will go back to where we were before the banks started pushing out credit, and we will make sure that they push out the same amount of credit in future. And when it comes to tariffs, let's just forget about tariffs, and we'll just that is unrealistic. So what I'm saying is that not only do you have the first tranche of monetary expansion from COVID-1, you're going to get another one fairly shortly from COVID-2, and then there will be further ones, because no politician in America, no politician anywhere in advanced economies with a welfare state can afford to stand back from the economy and say, this is too big. We're going to stop printing money and let people sort it out for themselves.
Yeah.
Nobody will take on the responsibility of all the bankruptcies.
People want stimulus. People are for stimulus.
But what they don't understand is that by this sort of pushing money into the economy, you're transferring wealth from the productive side of the economy to the government.
That's so true.
Which is unproductive. So actually what you're doing is you're killing your economy by this sort of production. Yeah. And if you just look at the history of countries like Germany, particularly after the First World War, the destruction of personal wealth. I mean, middle class is completely impoverished, the whole thing. Raiders from outside coming in with foreign currency. I mean, you could buy a house in a fashionable part of Berlin for $100 in November 1923. $100. That was the equivalent at the time. It was $20.67 to an ounce of gold. So it was equivalent of 4 ounces of gold. You could have a 6-bedroom house in a fashionable part of Berlin.
Yeah.
That is what
I don't know if
happens.
we'll get
That
there,
is,
but
that is the
I'll be
degree
buying.
of, but that's the degree of impoverishment that you get
Yeah.
in a hyperinflation.
Yeah.
And what I am saying is that we have all the characteristics already in the dollar of a hyperinflation, because we've had one, we've got the other one, and then we've got to deal with the underlying reality before COVID, if you like, interrupted everything and made us think, oh, well, the only problem is COVID. It's not. I can tell you it's
Yeah.
considerably greater than that.
Yeah. I also think what's interesting is with 2020 being the year of COVID and 2021 being the year that the vaccines will be administered here in the next few months, the economy will open up. It's almost like the price inflation will now begin to appear. This was like a reflation year, but next year, man, small businesses will get back to work. Everyone will go spend much more, will be more. So it feels more like 2010 in terms of what's coming. And that was a really great year for gold. Obviously, I think it went up like 60 or 70% in terms of like 2010 and 2011. And that's almost what I feel will start happening, because we're really coming off of the stop. The shutdowns in March and April was so severe. It literally stopped everything. And that was insane. So all this money, it's now in the stock market, but it's not going to just stay in the stock market forever, because there's so many newcomers that need that money eventually for other consumption things. So I think
well, can I stop you there, because
I'm asking you the question. Yeah.
I don't think your analysis is right. Okay, let me just take a step back. In the current situation, there are massive bankruptcies, not necessarily in the big companies, many of which should die, incidentally, because they are zombies. They are overloaded with debt, and they are not productive in terms of managing to finance that debt and produce a return on top without government assistance. I mean, governments will go in and rig the market so these zombies can continue, but that basically creates the need for more monetary inflation. The scale of bankruptcies that we're going to see in 2021 is going to be absolutely enormous and appalling. It's been made worse by COVID. Remember, we've got this background of the contraction of bank credit, which we probably won't see too much because governments are beginning to underwrite the banks' balance sheets. They're saying, look, we get this stimulus into the economy. I know that you think you've got bad debts with that customer, but we will guarantee any losses on those loans. So what do the banks do? They say, okay, fine, with the government guarantee, we let these bust customers have some money. I mean, they don't care anymore. So you've got this situation where, which is really highly inflationary, but everybody is, I mean, not everybody, but obviously enormous elements in the economy are going to go bust. Now, where the change in the price of gold comes from is not from that sort of comparison that you made with 2010, but where it comes from is the effect on the purchasing power of the dollar and every other currency that's going down this route of basically underwriting all the losses in their economy. So that is why you're going to see the purchasing power of fiat currencies go down the tubes. It is inevitable. And there is something else which I think your viewers and listeners should be aware of, and that is the relationship between the quantity of money and the purchasing power of money is not mathematical. There is obviously a mathematical element, but at the end of the day, you will find that it is people deciding whether they want to use this for transactions and to what extent they trust the money in transactions. Now, once they lose that trust, then the purchasing power, the fate of the purchasing power of the money is sealed. Basically, it goes to zero. Yeah. So this is a very, very important thing. And it does mean that because the purchasing power of money is not rigidly tied to the production of money by the central bank, that you can have a collapse in its purchasing power in a matter of months. And this is basically what has happened in the past in hyperinflations. The hyperinflations, incidentally, have always been with fiat currencies. And this time there is another thing which is worth introducing into the equation, and that is there is an old saying that not one man in a million, or not one person in a million, understands money. And they will only learn something about money once they suddenly realize that it's money going down, not prices going up.
Yeah.
Which comes back to the point we were making earlier. If it's the purchasing power of the money they're using going down. Now, there is a difference with this particular time, and that is cryptocurrencies. The point about cryptocurrencies is that it has educated a significant minority of people about the relationship between a currency whose issuance is limited and government currencies where issuance is unlimited. And these people have been buying Bitcoin, Ethereum, whatever the cryptocurrency is, on the basis that this is sounder money than government currency.
Okay.
So we have an intelligent community around the world who, ahead of the event, understand what is going to happen to money. Now, we never had that before. So the old saying that not one person in a million understands money is no longer true. Perhaps it's, perhaps there are 10,000 people in that million who now understand money. So, but the effect of that, I think, will be, if anything, to speed up the loss of purchasing power of these fiat currencies in a currency collapse.
That's a very interesting insight. It truly is. And I want to ask you lastly about gold money. Could you explain what goldmoney.com does?
Yeah, sure. I mean, we store gold for our customers as custodians, and we do that outside the banking system. So you have no counterparty risk with banks, and they are in fully insured vaults. And we offer, I think it's 11 or 12 vault locations around the world. So if you want to store your money in a different location from your location of nationality or residence, then we can offer you that facility. And we've now got, I think it's about 250,000 customers, something like that. And we're storing around about $3 billion worth of gold, silver, and platinum group metals.
That's amazing.
And that basically is what we do. And so it's very easy for you to buy gold, buy silver. I mean, you can go and buy platinum group metals if you want as well, but that's a slightly different thing. And we'll store it for you safely.
What is the best contact information for goldmoney.com?
Goldmoney.com. Go on the internet, and you can open an account. We do full, obviously, bank regulation standard KYC, which stands for Know Your Customer. Mm-hmm. We do that basically because we're required to do it by the regulators, and also to protect our other customers, so they know that Gold Money's customers are all, if I can use your phrase, kosher, and so there is, if you like, a risk from the custodian, if you like, sure. Sort of taking on, sort of doubtful customers. So we go through all that process very, very fully, and it helps guarantee, I think, the
integrity of it.
Integrity, yeah. Thank you. The integrity of our customers' holdings.
Okay. Well, it's been a pleasure talking to you, and let's see what happens with gold in the next few days after this interview is released.
It'll be interesting.
Options expiring for sure.
Thank you for asking.
Sir.
Yeah, thank you.
And